Students, today we will be covering Chapter 9, the cost of capital and capital structure. Please note that you have to cover intensively the cost of capital, but please ignore capital structure. I will not be covering capital structure as it is a theoretical subject. To begin with, the cost of capital, the rate of return on invested funds, plays an important role in corporate finance. A company's cost of capital is used as the discount rate. You will notice in NPV calculations, there's always a discount rate given to you in the appraisal process. It seeks to raise capital by the cheapest and most efficient method, thereby minimizing its average cost of capital, and its effect is increasing the net present value of a company's projects and its market value. Hence, shareholders' wealth is maximized. If you scroll down the slide, there is another definition where I'm highlighting now, and it states the cost of capital refers to the opportunity cost of making a specific investment. It is the rate of return that could have been earned by putting the same money into a different investment with equal risk. As you know, all investments have different risks. The cost of capital is the rate of return required to persuade the investor to make a given investment. Scrolling down the slide, what is the cost of capital? As you know, providers of finance, the people that will support the firm, require returns. The required return will reflect the risk of the investment. I'm highlighting this point now to inform you that the discount rate will act as a return to reflect the risk of the investment. Hence, if you see 10%, it reflects the risk of that particular investment. If you notice that the discount rate is 15%, it reflects a higher risk of the investment. Companies also need information about the cost of different sources of finance, i.e., equity finance, debt finance, to find the overall cost of finance. The overall cost of finance is the weighted average cost of capital, and to make investment and financing decision. The investment decision is to determine whether the project should go ahead or not. The financing decision is to determine what type of finance is to be used to finance the project. It could be equity finance, it could be debt finance, or it could be a combination of both. In the next slide, we will look at the individual sources of finance, starting with ordinary shares. Ordinary shares is also known as equity finance. You will notice that the formula to calculate the cost of equity finance, KE, equals to dividend in year 1 divided the current price plus the growth rate. If we reshuffle the formula, you will notice that this formula is derived from this particular formula. PO equals to D1 divided by K minus J. K here refers to KE. Hence, you can use this formula to determine the cost of equity. You will notice in the next slide There's the example given to you. Please read the example and comprehend the example. Understand what it has to do. Similarly, the cost of ordinary shares can also be found using the CAPM formula. This is another way of calculating KE. Hence, you will be required to know both the formulas given. Again, you will notice that KE, which is also known as CAPM, the required rate of return, is equal to risk-free rate plus the beta, open bracket, market return minus the risk-free rate. In the next slide, we talk about retained earnings. You notice that retained earnings has a cost. Do not ever think that retained earnings is free, right? In this case, we say that retained earnings has an opportunity cost equal to the cost of equity. The cost of retained earnings can thus be found in the same way as the cost of equity. It is a mistake to see retained earnings as a free source of finance. Moving on, the next source of funds we are looking at is preference shares. Similarly, if you look at the formula provided, this is how you calculate KPS. PS stands for preference shares. It is dividend payable divided by current market price. Please be careful when you calculate dividend payable, as you will have to look at the par value of the preference share dividends. Moving down the slides, this is the example which you will have to reflect on, and hopefully you will be able to calculate the cost of preference shares. Moving on, this is irredeemable bonds. We now look at how to calculate the cost of irredeemable bonds. If you notice, I've highlighted the formula, and it says interest payable divided by current market price of the bond. You notice that this formula is similar to the one on preference shares, except that in preference shares is dividends payable. For irredeemable bonds, it is interest. Similarly, if you scroll down the slides, there is an example given. Please note that when calculating cost of bonds, it has to be after tax rather than before tax. I've highlighted to you that once you've calculated the before tax KD, you are required to calculate the KD after tax. That is the final answer. Moving on, we also have redeemable bonds. The cost of redeemable bonds. The formula provided is this formula, right? But you need not worry about this formula. there is a similar formula which can be used, i.e. this formula. It is known as the Hawa-Nini-Vora formula. This is a simpler way to calculate redeemable bonds. Again, I will have to remind you that this formula will give you the before tax cost of redeemable bonds. Once you have identified the before tax cost of redeemable bonds, you have to calculate the after tax cost of redeemable bonds. If you scroll down the slides, this is the formula that you have to calculate. The 12.4 indicated is before tax. Hence, you will need to calculate the after tax. And you notice that 12.4 is before tax, after tax is only 8.7. Moving on, we look at bank borrowings. Now basically, what you have come across are the common sources of finance available to the company. There are more sources of finance that are not illustrated in these PowerPoints. Just focus on these few sources of finance. The last one we are looking at is bank borrowings. You will notice that bank borrowings are not traded and hence do not have a market value. You can't buy and sell bank borrowings. Similarly, when calculating bank borrowings, it can be found by dividing the average interest paid by average bond borrowings for a given period. Again, because this is under debt finance, the bank borrowings provided in the question will be before tax bank borrowings. You should calculate the cost of bank borrowings after tax. I have highlighted this here. And here. So once we have calculated the individual sources of finance, scrolling back, we started with equity finance, the first one. We move down to, and don't forget equity finance, there are two methods of calculation depending on the question. One is using dividend. The second one is using CAPM to calculate the required return. Similarly, we covered retained earnings. I mentioned retained earnings has an opportunity cost which is equal to the cost of equity. We then move on to learning how to calculate preference shares. And then from there, we move on to calculate irredeemable bonds. This is the formula that is highlighted. From there, we move on to calculate redeemable bonds. You need not follow this formula because there is another way of calculating redeemable bonds, which is using this formula. And lastly, we covered bank borrowings. So all in all, we've covered 5 different sources of finance. And if you recall, I mentioned any form of debt finance, you will always have to 1 minus T in order to derive the after-tax cost of debt. I will take a 5-minute break and subsequently continue to show you how to calculate the WACC.